Hello, Value investors. Thank you for joining me. My name is Michael from Deep Value Returns on Seeking Alpha. I recently came across a podcast about Riskified, so I just wanted to discuss what I think about Riskified. We're going to talk about its growth rates, we're going to talk about what the company does, and then we're going to talk about its gross margins. Finally, we're going to bring this all together and talk about its valuation. So here's the thing, right? So the company had just reported a top line growth of 47%. Okay, so far so good, right? So this company clearly growing at a rapid rate. The problem is that its guidance is really pointing to a rapid deceleration. So this begs the question: is it just the case that it's coming against difficult comps with last year's second half of the year, or is it a case that it's really just fizzling out, this opportunity? Because ultimately, we're going to talk about what Riskified actually does. So Riskified is essentially allowing the e-commerce merchant to sell as many packages as they want, or as many products as they want, and Riskified will cover them in case something goes wrong. There's some kind of fraud, okay? So it's a fraud prevention platform. Now, here's a few things that I wanted to highlight, okay? So as we go through this, it's difficult not to look at this company and consider it an insurer, but let's just try, for the sake of the discussion right now, push this aside, okay? Let's just focus on the fact that it's serving customers, and it allows the merchant there, which is Riskified's customer, to serve their customers. So it's kind of like a layer on top of the e-commerce solution, okay? So for what they say in their filings is approximately 10 to 15% of all packages that are delivered by the merchants go missing, okay, due to fraud or other sources, okay? So what Riskified is saying is, okay, if a merchant comes with us, not only have the average, top 10 merchants that use Riskified have found that they're able to increase their revenues by 8%, they're also able to decrease their losses substantially by up to 39%. So you're getting, as a merchant, more top line growth, and you're having 39% less in operating expenses. So this sounds really, really compelling, and obviously you're getting a very high return on investment if you are a merchant, right? So you kind of come on board and you use this, and that's why the net dollar-based retentions are higher than 100%. So I can see the appeal, right? That makes a lot of sense for the merchant. The question is, can Riskified's business model make this economically viable? And that's the question, right? So here's the thing, right? So for Q1 21, they will approximately break even, and then for Q2 21, they went to 3% EBITDA profitable. Okay, so 3% margin. It's not like, but it's not very compelling, but it's fast, rapidly growing. Kind of that's the theory, at least, right? So they're kind of investing for growth, and investors shouldn't really care about its profitability right now. That being said, towards the back end of the year, particularly for H2, they're kind of pointing towards finishing the year at negative 11%. So on a EBITDA margin, so it makes you think right away. Okay, so it clearly is going to be growing quite unprofitable in the second half. Probably as low as negative 15%. Even if they're kind of being a bit conservative there, you're kind of looking at least 13% negative. So it goes from a company that's kind of close to break even on close to positive EBITDA margins, and they're going to go negative. So you have a company that's not growing very fast. The visibility that they're offering investors in terms of the sustainability of its growth rates is not there, and it's substantially unprofitable. So this is like a triple whammy. And then let's discuss about the fact that it's priced at 11 times forward sales. I mean, I think about this, right? So even right now in 21, when many of these SaaS stocks are no longer really being priced at such a high multiple, many SaaS stocks now, and like now around the 10 or even less single digits forward sales, this is not a SaaS company. This is most likely, I can't see any other way than this is an insurance company. And if you look elsewhere and you look at the insurance companies, you're going to be paying approximately 2, maybe sometimes 1 times forward sales. I mean, so why would you pay 10 times or 11 times for this? I think it's very difficult to build like a particularly bullish case. And I could be wrong, and I'm often wrong. But anyway, this is why I'm avoiding this name. If you want to find out what kind of names I'm interested in, don't forget to check out my marketplace. It's called Deep Value Returns. I'll help you become a better investor, help you think through build a framework to become a great investor. So I give you high quality, actionable investment insights. And yeah, as always guys, I hope to see you next time. Okay, bye.